Well, moving on now, the year 2020 has proven to be one of the most remarkable years for the financial markets in the global front. Now, despite the worst generational crash accompanied by the COVID-19 pandemic, unprecedented stimulus measures and vaccine breakthroughs have sent stocks roaring back to record highs. Regardless of the insurmountable job losses recorded in the year amidst a global recession, world stock markets ended 2020 up 13%. But the markets began to soar up gains with the introduction of initiatives by the central bankers across the world, slashing borrowing costs to record lows and launching massive new assets purchase programs while governments try to prop up their economies with packages such as UK job retention schemes. With all of this series of events which shaped the global market trends, let's now discuss the activities of investment portfolios, volume of transactions, and forecast for 2021. Well, I won't be doing this alone as usual. Joining me live from United Kingdom is an investment analyst and stocks coach, Mr. Gbenga Onifade. Mr. Onifade, I thank you very much for your time.
Right, thanks for having me. Thank you. Good afternoon.
I don't know if I should start with the lockdowns and what is really happening in the UK at the moment, how this is affecting trading and all of that. Can you quickly take us through that before we now go deep inside our discussion on analyzing global markets?
Thanks for asking. I'm keeping safe. I believe this is the right thing to do. Everyone is actually been, staying indoors and, of course, keeping safe. We don't really know what we're doing right now, actually, because things are ebbing and flowing. But I've got to say, they are doing what's the best thing for the economy. Of course, everyone's actually trading right now in their own homes. Everything is obviously automated. And yeah, so things are going okay, and we've been safe. And I guess, like I said, on the real trading floor nowadays, you don't really need real people there. It's all being controlled by the systems and the machines. So yeah, I think it's not a lot of shifts has affected us in that regard.
Wow. So let's now look at what has influenced the performance of the global market despite the COVID-19 lockdowns that we've identified and or the COVID-19 pandemic.
Oh, okay. It's a different year for 2020, actually, because if you look at the markets, we do actually realize that the market doesn't exactly reflect what's going on in the economy. And 2020 has actually been one of the best times for the market, even though it's been one of the worst times for the economy. But this has actually been a very artificial market, with the government spending, which is, of course, it's actually gone very low. It's not actually high at all. But the government policies and the Federal Reserve, which controls the global market, they've been doing a lot of printing, so we are actually in a very artificial market, and they've actually been artificially pumping the market. And the other thing, if you look at it, the fact that more people are at home, there's been a lot of money being given to them to sustain themselves. So that money is actually been fed back into the market. So the market is not reacting or is not reflecting exactly what we are seeing in the real world.
Well, it's quite interesting to stay at home and still get some money. That will be interesting. I can't stay at home. I have to be here. Now, what did central banks do differently, to help revamp the global market sector?
Okay, one thing we've got to understand is that we are in a very negative interest rate economy. And, we all need to have this risk adjusted basis for our portfolio, because if you think about it, investing is a very personal thing, number one. Number two, it's a permanent everyday learning curve. So what do the markets have to do right now? Because the markets, they need to carry, and they want to make sure the economy is going. And if you look at the GDP, it grew at 2%. However, if you think about the projection right now, Goldman Sachs is predicting about 3.9%. Credit Suisse is looking at 6%. So I'm looking at the average about 4% for 2021. Of course, things can change. However, the governments, they want to keep things going, because what are the key indicators that drive the economy? I tend to look at the government policies and consumer spending. So again, let's just take America into perspective. Joe Biden is actually thinking, okay, I want to give more people, more money so they can spend, because this is all about encouraging the people to keep spending more. In the UK, for example, we had to go to negative interest rates whereby you actually get charged for keeping your money in the bank. What does that mean? Inherently, they have to go there and spend their money. So that's some things the central banks tend to do.
Investors' confidence is key in any market. Despite what happened in Nigeria, we still saw the market ending the year, doing very well, perfectly well, and everybody commended the market. Now, what's your assessment of investors' confidence at this time, considering all of the global challenges we face? And like you also identified, Joe Biden will be inaugurated just on Wednesday, and a lot is also happening in the market around the United States.
Okay, one thing is we've got to give the credit to Nigeria. I don't know how they did it, but Nigeria's stock markets ended up being in the world. About 99 countries where they were actually checked. The data was checked, and Nigeria ended up being the best in the whole world. I looked at during the whole process session in October, and the economy was still doing very well. One of the things, the assumptions I came across was the fact that if you think about the treasury bills is at an all-time low. The bank's interest rate is actually rubbish. So people are actually putting their money in the stock market because that's the only place they can put it, and they are getting the good results. Especially if you're being patient. So that's one area. Generally, investors' confidence are very, very low but that's for the people who don't really know. Because if you think about it, people are using the economy to judge the market, but the market is actually always forward-looking. Right now, 2020 and 2021, for example, 2020, which is just a concluded year, it's given us a lot more positives. We had the biggest vaccine was discovered in history. It's very well on the environment as well. Kenya's elephant population is doubled, for example. If you look at that area now, investors' confidence quite low, but the people who have been very patient and who have always been forward-looking in their investment area as well, and who are constantly taking some upward, balancing their risk with the market, they are actually getting paid, getting rewarded. One other thing again is if you look at the biggest investors in the world, I'm talking about the hedge funds, the insurance companies, or the corporate organizations, they are looking into, they all believe we now need to do things different. People are looking at the big data, for example. People are looking at artificial intelligence. We're looking at environmental, social governance as part of our investors. And like I said, the reward is actually already taking place right now. So while investors' confidence are low, but the people who are invested and who keep staying invested, they are actually getting rewarded. Yes.
Let's look back to 2008 when that big fall, when that global meltdown and all that affected the markets. Now, what have we learned? What has changed from the tactics used in 2008?
This is a really great question. In 2008, I think nobody saw that coming, but some people were actually able to predict it, and they made millions because you could tell. How would you be able to buy, a house worth $1 billion off a $30,000, job? So that was actually caused. That was caused by humans, really. But that of 2020, the whole world got it wrong. Everybody got it wrong. No one saw this coming. The best of the best financial experts out there, they all got it wrong. But what have we learned? One thing I'm going to tell you is, for example, I'm actually looking at big data. I'm looking at the future of medicine. One thing I know right now is, before back then, we tend to look at data of 10 years, we tend to use that to focus. But right now, companies are looking at literally 2-3 months data, and they use that to predict. Things are being very accelerated, things are changing very fast. So we now realize we need to move very fast enough, faster than we are moving. That's number one. Number two, in 2008, when we had the global meltdown, we were just literally looking at our pockets. Oh, this is not good for us. And then there were some measures that were taking place, but that were put in place by the government in such a way that this can be prevented. But some of these measures that were not taken care of or that were not considered were, we didn't think about the environment at all. We were screaming about the environment, but we're not doing anything about it. So now that's number one on the key. Every company is now thinking about ESG as part of their portfolio. As every company is labeling themselves. The minute you talk about yourselves as being renewable, straight away you could tell your your capital is just gonna, is just gonna double, almost will double. People are looking at that one. People are looking at the human side of things as well. So we're talking about global social governance. We're looking at people. We're talking. So we are trying to get very local, even though we are still very global. But we are trying to get local as well. So we think even influencers, they are forming a part of our norm, a part of our portfolio. Now, robotics, another one. That's another thing. Remember, that was all about real estate in 2008. But now we're looking at the future of medicine. We're looking at ourselves. We're looking at robotics. We're looking at literally technology is driving everything. Even software is a service right now. We're looking at infrastructure as a service. So these are the other ways we're thinking about. So now I think people are not taking anything for granted at all.
Yeah, on a final note now, let's not look at the stimulus package being doled out by government, to help stimulate growth and, kickstart the economy again. Do you see this having any effect on trading the exchange?
Okay. So with the 2020 results is going to be coming out in the first quarter, I think in January, sometimes from this week to next week. So one of the other things people need to realize, and you as a trader or an investor, I do both. One thing people need to realize is now we've got fake money, which is being printed, really, pumped into the economy, and there will be a consequence point, because where is this money coming from? It's artificial money. You're pumping it back into the economy. People pump the economy as a result, and 2020 results might look better than you think it is. So you've got to be very cautious. For me, generally, I tend to wait the first quarter just to be patient, because if you think about it, for example, China, their economy is already bounced back straight away, while the rest of the first world is still struggling. So one thing we've got to think about is you've got to be patient. The result might look better than it is, and people might straight away start having that false assumption, thinking, oh no, 2020 wasn't that bad actually, but it is actually really bad. There has been fake money, which has been pumped. They call it quantitative easing rather, which has been pumped into the economy. Joe Biden, for example, said he was going to double that money from $600, which he thinks wasn't much at all. Of course, you're taking risk adjustment status in this situation. However, the result might look greater than it was or than it should be, but you've got to be very, very cautious. You've got to be careful. So one thing I tend to tell people, you've got to diversify broadly, and especially even if you're the retirement age. Look at ETFs, look at different countries. Don't because most people tend to focus on the American, but you've got to think, okay, think about what they are doing on the parallel deep inside. They are printing out money. The Fed Reserve, they want to keep it up as much as possible, but at some point any bubble will burst. So you want to be careful, because you can only maintain something so much. It will collapse on its head. But for that to be prevented, then you've got to think, okay, let me look elsewhere, because I've got to diversify as much as possible. So take a gentle, cautious approach, approaching the year before you actually just pump all the whole money there, thinking, oh, it wasn't that bad actually. Because this year, for example, like I said, they were looking at about 4% increase in the economy. But from a trader's perspective, traders tend to drive the market. They're looking at short-term gains. But if you're an investor and you want to take a long-term approach, then you've got nothing to worry about. But if you are a trader, if you get the results, don't think that's the best thing you will get, because there's a lot of artificial hands in this economy.
Mr. Gbenga Onifade, investment analyst and stocks coach. I must tell you that we'll keep a tab on you. We'll monitor all the trend. I will have you join us again to tell us what plays out as things move on in 2021. Thank you very much. I appreciate your time.
Appreciate that. Thank you.